So, where do market returns come from? What are the factors that drive them? Essentially, market returns are compensation for providing the financial capital that feeds human enterprise. Of course, when you buy a stock or a bond, you're not giving your money away. You expect to receive your capital back, and then some. When you buy a bond, you're lending money to a business or government agency. Your returns come from interest paid on your loan. If the business or agency defaults on its bond, you're closer to the front of the line of creditors to be repaid with any remaining capital. When you buy a stock, you become a co-owner in the business. Your returns come from increased share prices, dividends, or both. If the firm goes bankrupt, you're closer to the end of the line of creditors to be repaid. Stocks are considered riskier than bonds and have generally delivered higher returns over time. This outperformance is called the equity premium. There's always an element of risk when investing. There's no guarantee you'll earn the returns you're hoping for, or even recover your stake. And that's why basing your investment strategy on solid evidence makes so much sense. Scholars have been studying factors driving market returns since the 1950s. Their work exhibits 4 main characteristics. First, it's genuinely independent and unbiased. Second, it involves robust data analysis, for example, ensuring that data isn't tainted. Thirdly, any results must be repeatable and reproducible. Last but not least, scholars have to publish their work so their peers can review it. These are all reasons you can rest assured that the research on which evidence-based investing is founded is thoroughly reliable. Over the years, scholars have identified 3 main factors that drive stock returns. We've already told you about the equity premium. There's also the small cap premium. That is, small company stocks return more than large company stocks. The third factor is the value premium. In other words, companies with a lower ratio between their stock price and metrics such as earnings, sales, or cash flow return more than growth companies or those with higher such ratios. Similarly, academic inquiry has identified 2 primary factors driving fixed income, or bond, returns. The first is term premium. That is, bonds with distant due dates have returned more than bonds that come due soon. And the second is credit premium. In other words, bonds with lower credit ratings have returned more than bonds with higher credit ratings. In recent years, 2 additional stock market factors have been identified. The first is the profitability factor. That is, highly profitable companies deliver higher returns than low profitability firms. The second is the momentum factor. In other words, stocks that have done well or poorly in the recent past continue to do so for longer than random chance seems to explain. Before we get carried away, remember that even if a factor exists in theory, we still need to be able to capture an expected premium without generating costs beyond its worth. It can also be difficult to build one factor into a portfolio without sacrificing another, so benefits and trade-offs must be carefully considered. Helping you decide which premiums you want to try to capture is one of the key roles of an evidence-based advisor. So, we've explored a number of factors which drive investment returns, but perhaps the most important of all is the human factor. Find out more in our final video.